Assalamu alaikum class. In this lecture, we will learn to record the transactions related to bonds payable and interest payable. In the previous lecture, we have learned to calculate the amount related to interest expense to be recognized and cash payments to the bondholders. In this lecture, we will pass the journal entries related to these transactions. We are using book Financial and Managerial Accounting by Williams Haka Bettner, and we are covering chapter 10 liabilities. Uh, this particular lecture belongs to exercise 10.9 and 10.10. So let's get started. Here we have Excel sheet, exercise 10.9. In this problem, we have $8 million, $8 million bonds payable. The company issued it on 1st April 2011. The time of maturity is 20 years, and the percentage of interest is 8%. And important thing, the company issued it or issued it at 102. 102 means $100 bonds are issued at 102, means this 2% represent the bonds are issued on premium. So interest is due on 31st March and September 30th, means two times a year. So the interest payments are semi-annual payment. And the maturity date is 31st March 2030, 31 means after 20 years. The company fiscal year ends on December 31st. Prepare the following journal entries. First entry is to record the issuance of bonds. So we have a date column, then we have accounts titles, then we have a debit column, and then credit column. Okay, the first entry would be on April 1st, 2011, and the entry belongs to the issuance of bonds. So whenever company issue the bond, the company get cash. The cash will be debited, and the company issue bond on premium. You can see at 102. So premium on bonds will be credited, and then here it is bonds payable. And then liability will be credited, which is bonds payable. So this is the entry. How we are going to calculate the amount? First of all, cash. So how much cash the company is getting, which is 8 million bond issued at 102 rate. So the company will get $8.16 million. The premium on bonds. So the face value of bond is 8 million multiplied by premium is 0.02. So the premium would be, here it is, $1,60,000, and the bonds payable, which is the face value, which is 8 million. So this is the entry number 1 to record the issuance of bonds on premium. The next requirement is on September 30th to pay interest and amortize the bond premium. So the next entry would be on September 30th, 2011. And the entry is bond interest expense. So because this is expense, so it is on the debit side. Then we are going to amortize this premium. Premium is initially recorded on the credit side. So whenever we amortize that premium, we record it on the debit side. So premium on bonds payable. And then we record the total cash paid to the bondholders. How we are going to calculate this amount? First of all, we have semi-annual interest payment. How interest payment? So we are going to calculate interest payments. Total face value of the bond is 8 million, and interest is 8%. So we are going to multiply it by 8% to get interest. And then because the payments are semi-annual, so we divide this interest by 2. So this is the total semi-annual interest payment. Interest payment means this is the cash which will be paid to the bondholder. Then less amortization of premium. So total premium, you can see the total premium is 1,60,000. So we are going to amortize it. How? This 1,60,000 will be divided by 20 years because the total time of maturity is 20 years, and over times the years means we are using semi-annual payment. That's why we are dividing it by 2. So this is the 4,000 amount. Uh, the amortization of premium is basically deduct or decrease the interest expense which are recognized in the income statement. We have discussed in detail in the previous lecture. So we deduct this amortization amount in the total interest payment minus 4,000. So we get 3,16,000. So how we use these amount? This is the semi-annual interest payment. Payment means we are going to pay to the bondholder. This is the amortization amount, and then the interest expense recognized. So here we have bond interest, which is 3,16,000, then premium, which is 4,000, and on credit side, which is 3,20,000 dollars. So $3,20,000. So this is the next entry, which we have already recorded. The second entry, the third entry on March 31st, 2031 means on the date of maturity to pay interest payment, and amortize the bond premium. Bond amortization of bond premium is required, and retire the bonds at maturity. Bonds, the next entry, which is related to retirement of bond maturity, is required. And one thing is mentioned that make two separate entries. Separate entries means we are going to record retirement of bonds separately, and the interest and bond premium separately in another entry. So the fiscal years and on December 31st means after December 31st, we are going to record this entry for 3 months. Means uh, January, February, and March. So these amounts will be calculated for 3 years. Here we have calculated this interest payment. We can take this data, and here we use 4 because we are calculating this amount for 3 years, for 3 months. So there are 4 quarters. So this is the semi interest payment. These are the semi annual payments. So either we can divide these amounts simply by 2. You can see that 3,20,000. This 3,20,000 is for 6 months. So next entry is for 3 months. So we divide it by 2. Again, this 4,000 will be divided by 2, and this uh, 3 316,000 will be divided by 2. So these are the amount for uh, 3. These are the amount for 3 months. As we are going to pass the entry after 3 months, means March 31st, 2031. First of all, you can see that on 30th September, the last payment was on 30th September. Then we record interest payable. The concept of adjusting entries. Based on that concept, we have discussed in chapter 4 the concept of adjusting entries. So we accrued interest payment, which was the bond interest payment. 3 month payment belongs to October, November, and December because last payment was done on 30th September 2030. Now, on 2030, the payment of October, November, and December was due. So that's why we are, first of all, we are reducing that liability by bonds interest payable. Then we record the interest expense for the 3 months starting from January, February, March of 2031. So, interest expense or in interest bond interest expense, here we have bonds interest expense. And then we are amortizing premium on bonds. So, premium on bonds payable, and then we are paying cash because the payment of cash would be for 6 months after 30th September because last payment was done on 30th September 2030. After 30th September, no payment was made till 31st March 2031. So from September 30th to March 31st, there are 6 months in between. The 6 month payment is basically 3,20,000. We have already discussed. Here, all amount would be in dollar. So 3 month interest payable is 1,60,000. And bond interest payable for the remaining the interest which is going to recognize for the remaining 3 month is 1,58,000. So this is 1,58,000. And a bond premium which is for again 3 months from January to March is 2,000. So yeah, this is the complete entry. Here, the difference between these two entries is basically the total interest is divided on the interest expense and the interest payable. This interest payables belongs to the 3 month of 2030, means October, November, and December of 2030. And this interest expense belongs to the 3 month of 2031, means January, February, and March. And this is the bonds premium of that 3 month, January, Feb, and March. And the payment will be recorded for the 6 month on 31st March 2031. The last entry, which is related to the bonds, retirement of the bonds. So 31st, March 31st, 2011. No, it should be 2031. So at the maturity date, what entry which we are going to pay, which we are going to record, you can see this one. So liability will be decreased. Decrease of liability is recorded on the debit side. bonds payable, and the company will have to pay the cash to the bondholders, or you can say the company will have to return the cash to the bondholders. The amount is the face value, which is 8 million. So this was the requirement A, B, and C, recording of the entries. The next is the part D. Briefly explain the effect of amortization, amortizing the bond premium upon net income and net annual cash flow from the operating activities. You can see this amortization of premium. So we decrease this amount from the interest expense recognized. In simple word, we can see that amortization of premium basically decreases the interest expense. So ultimately, it increases the net income, because decreases of any decrease in any expense means increase in the net income. So the effect of amortization of premium is basically increases the net income. And the second part is annual net cash flow from operating activities. So first of all, bonds, a payment of bonds or issuance of bond is not an operating activity. So it does not affect any operating activities. And then amortization of premium is a non-cash entry, or it is a non-cash adjustment. So that's why the amortization of premium will not increase or decrease any cash flow from operating activities. So this was exercise 10.9. We are going to apply same concept on the issuance of bonds on discount. So here we have example, next example 10.10. In 10.10, you can see what data we have. We have $5 million bonds payable, maturity time is 20 years, interest rate is 9%, and issued on 1st July 2011 at 98. 98 means $100 bonds issued at 98, which means that 2% is the discount on the issuance of the bond, and the interest is due two time a year, that is June 30th and December 31st, means the interest payments are semi-annual payments. And the fiscal year is December 31st. So what is required? First requirement is on July 1st 2011 record the issuance of bonds. So first is the recording of issuance of bond. The time is July 1st 2011. So whenever the company issue a bond, the company get cash. We recorded premium on bond on the credit side. So now we record discount on bonds payable on the debit side. Discount on bonds payable on the debit side, and bonds payable on the credit side. So compare it with the premium. Here you can see premium is on the credit side. Now that's the bond is on the debit side. How we are going to record it? Total bond is for 5 million. And what company is getting? Company is getting less than the face value, which is 0.98. So this is the total cash the company received. Discount, the discount is 2%. So 5 million multiply by 2%, or 0.02. And The total face value of the bond is 5 million. So this is the first entry. The second entry is on December 31st, 2011 to pay the interest and amortize the bond discount. So date is December 31st, 2011. And we are going to record bonds interest expense because interest expense is on the debit side. And then the discount, we have recorded discount on the debit side. So when you amortize it, you record it on the credit side. So discount on bonds payable. And at last, we have cash paid to the bonds holder. The calculation, here we are going to calculate the amount semi annual interest payment. So total bond amount is 5 million. We multiply it by the interest rate, which is 9.5. So 9.5%, and divide it by 2 because payment are semi-annual payment. So this is your total semi-annual interest payment. The next is we are going to add discount on bonds payable. So discount on bonds payable will be calculated in this way. Total you can see here, total bonds, a discount on bonds payable is 100,000. This will be spread over the life of the bond, which is 20 years. So 100,000 divided by 20, and then again divide by 2 because we are using semi-annual payment. So the discount would be 2,500, and this will be add in the total interest recognized, means bonds interest expense. So when you add these two amount, you get 2,40,000. So you can see this is the total expense, this is the total amortization, and then this is the payment to the bond holder. So you can see this is amortization of discount on bonds payable. Okay, so total interest which is recognized in the income statement is 2,40,000. Discount is 2,500, and total interest payment is 237,500. So this is the entry to record interest payment and amortization of discount. The next entry is on June 30th, 2031 to pay interest, amortize the bond, and retire the bonds at maturity. Two separate entries are required. So first entry would be on June 30th, 2031, means after 20 years of the issuance of bonds. So here you can see we are going to record again the entry We have this entry amount is same because after the last payment was done on 31st December 2030, and after 6 months the payment is required, so we are going to pass the same entry here. All amount are same because time period is same, the 6 months, so we have passed this entry after 6 months, so amount are same. Then next entry is related to retirement of bonds, which is on June 30th 2031. Retirement of bonds means liability will be on the debit side, this that is bonds payable, and then cash will be on the credit side because company is paying back to the bondholders. How much amount? 5 million. So this was the complete problems related to the recording of the bonds, issuance of bonds, recording of the bonds. You can see just one more thing, that whenever you issue bond on discount, then discount will be recorded on the debit side, whereas you can see premium on the credit side. The next entry while recording the interest premium, this premium is basically the amortization of premium. That's why it is on the debit side. So the amortization of discount is on the credit side. So that's it from this lecture. We have discussed that amortization of premium is basically decreases the interest expense recognized in the income statement, thus increases the net income. Here, in the case of discount, this discount increases the interest expense recognized, and that's why it decreases the net income. The effect of discount on bonds payable is basically, the effect of discount is basically decreases the net income, whereas the premium increases the net income. So that's it from this lecture. Take care, class.